Investing often feels scary because money represents security, and risking security triggers deep psychological alarms that evolve to protect us from loss, uncertainty, and danger. Many people understand investing is smart. Long-term, yet short-term market swings create emotional discomfort, making logical decisions feel dangerous despite strong evidence today. Our brains prefer certainty and immediate rewards, so steady salaries feel safer than volatile portfolios, even when historical data shows markets usually grow over time. Loss aversion also plays a role because people psychologically feel losses about twice as strongly as gains, turning normal volatility into something truly terrifying sometimes. When markets drop temporarily, investors imagine permanent disaster, even though downturns are natural cycles that historically recover and continue building long-term wealth for investors. Media headlines amplify fear by highlighting crashes and crises, rarely emphasizing decades of gradual growth that quietly reward patient investors who stay disciplined long-term. Another reason investing feels risky is lack of control, because markets move due to countless global factors that individual investors cannot predict consistently or perfectly. Humans naturally distrust what they cannot control, so unpredictable charts and economic news create anxiety even when diversified strategies reduce risk significantly over long periods. Friends or relatives losing money can also reinforce fear because personal stories feel more powerful than statistics showing millions successfully building wealth through investing patiently. This emotional bias pushes many people toward saving only cash, missing opportunities where compounding in time could dramatically increase financial freedom over future decades ahead. Ironically, avoiding investment risk often creates a bigger risk because inflation slowly erodes purchasing power, while uninvested savings struggle to grow meaningfully over long periods. Understanding these psychological forces helps investors recognize fear as a natural reaction rather than reliable financial advice, guiding their decisions in complex market environments today. Once you see why investing feels risky, you can start separating emotion from strategy and focus on evidence-based approaches for smarter long-term investing. The key shift is realizing risk and volatility are not identical, because temporary price swings are normal, while permanent loss usually comes from poor decisions. Long-term investors reduce risk by diversifying across industries, countries, and asset classes, ensuring no single event can destroy their entire financial future completely ever. Time in the market matters more than timing the market, because consistent investing smooths volatility and allows compounding to perform its quiet magic over decades. Instead of reacting emotionally to daily price changes, disciplined investors follow simple plans like regular contributions and periodic portfolio rebalancing to maintain balanced long-term. Education also transforms fear into confidence because understanding historical patterns shows that downturns are temporary chapters inside much longer growth stories for patient investors everywhere. Starting small can help psychologically, since even modest investments allow beginners to experience market fluctuations without feeling overwhelming financial pressure or panic during downturns ever. Automation is another powerful tool because automatic monthly investing removes emotional hesitation and ensures consistent participation regardless of headlines or market mood any given day. Over time, investors begin seeing volatility differently, recognizing dips as potential opportunities to buy assets at lower prices rather than reasons to panic or quit. This mindset shift transforms fear into patience, which is one of the most valuable traits any successful long-term investor can develop over many years. Remember that nearly every major market decline in history eventually recovered, rewarding those who stayed invested, while others exited during uncertainty and missed later gains. Smart investing, therefore, depends less on bravery and more on systems, habits, and patience that protect you from emotional decisions during stressful market moments always. When strategy replaces impulse investing, stops feeling like gambling, and starts behaving like a structured path toward long-term wealth creation for patient, disciplined people. If you want more simple explanations about money investing and financial freedom, subscribe now and keep learning strategies that make your future wealth stronger today.